welcome. Yeah, look here to discuss the market with you. And you have my cohort in crime here. Mark, you there?
Yes, I am. How is everybody?
Yeah, yeah, good to see everybody. Jim, good to see you and everybody. So, yeah, let's jump in. I think we'll start with maybe a little bit 30,000 feet up in the airplane view of the market, what's going on this week, what's going on, period. And then we'll dial into look at a few strategies, hopefully be a help to you. And uh, all right, so let's start with, as you see, I just happen to be using today Think or Swim, and you have a chart here of the last year in SPX, and got a few little things here. Here's a 50-day moving average, just things a lot of people look at. And this would be a 200-day moving average. And I have the implied volatility on here. And then I have something like average true range on here. So I have a few things. And Mark, what, as you look at, this box that I drew here is basically SPX this year. The first quarter, basically your first quarter in a couple weeks here. No, I mean your first quarter plus 11 days. What are your comments? What are you seeing?
Well, I mean, obviously we've had a fairly wide range in the market. January, of course, was a real tough one, really down. After that, it's tried to create a range. And here lately, it's sort of had one, but it has been something you have to be very aware of the trades you're using, and how volatility is going to affect them at different points. And of course, something that you can handle in a wide range of prices because the SPX is moving all over.
Yeah, good point. And what stands out to me is how many of you are used to trading in an environment where the last 13 weeks have been, we're in a downtrend. In other words, most of everybody watching this today, I would say your experience over the last 3, 4, 5, 6 years has been, we typically go up. And here, as you see here, the high of the year 48.18, that was on January 4th. We went down 10%, and then you got all the Russian stuff going on, kept it heavier till this, I think this was February 24th lows. Then we came back and you had this big up 9 days or so, then a little bit of a range. We're coming down, but still, most people think that probably when we bottomed here, hey, just normal. But, as we look at the market today, we're still down about 8.5% from the highs in January.
Yeah.
So the toughest thing is folk don't, most people aren't comfortable trading in a bit of a downtrend. You say, Dan, how do you know? Here's the reason. You haven't had one, right? When you think about it, the COVID correction in 2020, the market went down about 30% in 5 weeks and then started bottoming out. Here, we're still in a downtrend, basically, 14 weeks, almost 3.5 months into the year, over a quarter of the year. And people aren't used to that. It's a different environment, right? It's marked by higher volatility. It's marked by not great execution on the downside. And, so I think it's frustrating for a lot of people. Wouldn't you think, Mark?
Yes, I think that's the thing. People get scared and frustrated when they're trying to deal with particularly down moves, which can be very violent many times. And you really need a plan to be able to navigate through that. And so many people don't have a plan, and if you don't have a plan in trading, particularly in this market, you're going to be in real trouble real fast.
Yeah, what we've been trying to do is just trying to focus on, we'll usually look a couple months back at the price chart, a couple months back at vol, and you say, why? Why do you focus on the last 2 months or so versus this previous environment? Well, because this is our reality. It's like saying, I live in Chicago and, it's February and it's snowing, but I'm going to drive my car like it's June and 80 degrees because that's where I like to think about. And I go 70 miles an hour and end up in a ditch. Well, this is our reality, and so all of our energy is put into, okay, based on how the market's moving, based on where the volatility levels are and everything, what strategies are we comfortable? And we'll talk a little bit about today. So if you look at, and I'll make a little thing here, if we go to the next step before we look at some strategy. So basically what I see is, this concerned me recently. These, that usually doesn't bode well when we go faster on the upside than we go on the downside. But you can see this kind of stuff, a little bit of two-way, things are settling a little bit, right, compared to that.
A little bit, yeah, here recently.
Yeah, recently. But we're still, in a bumpy environment. Now, if you look at the VIX, breaking that period down again from, February till the current, how many are aware that we're not in a 14 to 18 volatility environment? How many has anybody noticed that? Raise your hand if you've noticed, hey, Dan, we are not in a 14 to 18, 14 to 19 VIX environment. Were you aware of that? Yeah, and that's okay. I think these have been a very good period for, for trades, because you're getting, again, it's always, you get used to something, but if you asked me for the next year, would I rather a downtrending market or an uptrending? I'd much rather a downtrending and some type of range within that because you get higher premiums. I'd much rather have that. Now, with that being said, we're looking at this range of, the reality is the range is 20 on the low end, kind of 35-ish on the upper end of the range. Mm-hmm. And the medium would be about 27 and a half. So, generally things like calendars we don't do in the teens, but you can make a heck of an argument in this environment, with the VIX at, let's see what the VIX is right now as we speak. VIX is at 2335. I'd have no problem considering a calendar, even though I'm more comfortable doing them in the teens, like Mark would say. But if you look at the volatility environment, this is our reality right now, right? And so we trade within that. I mean, it looked like last week, just for a brief period, right, Mark, that we were going to break under, or we broke under 20.
Right.
That was short-lived.
Very short.
Again, this is our reality, right? And Vadim says, wait for the CPI on Thursday. What do you see as like significant news this week, Mark?
Well, I do think the CPI is significant news. By the way, it's tomorrow. Is the CPI.
Okay. Is it tomorrow?
I think that could be very significant. And you got these Fed speakers speaking every day, but Fridays. Well, not Wednesday. Today, Tuesday, Thursday. Anything the Fed says this market really keys on. But I think that CPI number will be big. It's supposed to come out tomorrow morning at 8:30 Eastern. So yes, that's the big news. And of course, anything that develops out of, the Ukrainian conflict, that'll certainly have an effect.
Yeah. And all right, well, let's look at a few things. And remember, I'll just say this because this popped in my mind. Well, I'll tell you what, let's move over towards SPX, Mark.
All right.
So with that being said, And I've got a bunch of things to look at here, but let me just start with something maybe. I also want to talk about calendars too. We'll go quick over some things, folks, and this should be recorded, so you'll be able to go back. So here's a question for you. This is just a put credit spread, and we're at 44.37. And I'm using May 6th expiration for some of the examples I'm talking about today. Okay, Mark, that's like 25 days out. And we'll just start with an easy one, a May 6th, and this is the trade. Sell one, buy one. Everything's going to be May 6th. I'm going to sell a 4,200 put, and I'm going to buy a 41.90 put for around $1.50 credit. All right, folks, here it is. What is that? What is this?
No one knows.
No, we have one put credit spread. Some people might call it a vertical credit spread, bull put credit spread, whatever you want to call it. Now, folks, in a higher VIX, and not really higher lately, but used to looking, over 20, what happens on a day like today? Let me just look at this. VIX is 2345, up 229 today. Who can tell me what happens to put credit spreads on days the VIX goes up? What happens to put credit spreads? How does that affect? Well, you get more premium. Yeah, I mean, obviously it can go against you, but the higher the VIX, the more credit you will get for a put credit spread and the more room you get. Like here for a 25-day trade, we're selling a put at the 4,200, and then we're buying a hedge against it at 41.90. So our risk is the difference in the strikes, $1,000 less our credit. So we have risk or 850 margin, and our deltas are less than a delta long. So, we've been down 3 or 4 whatever days, but as part of a plan, again, and not directional, but part of a plan, doing an out of the money put credit spread makes sense to me on a day like today, among other trades. It'd be one idea. Again, I don't know whether the market's going up or down, but I'm looking at, you're under a delta long, so it's pretty relatively neutral. You have no risk on the upside. You've got 237 points on the downside. And that's a trade. So if this is 850 a margin, maybe you look, Mark, to get just give you a rough. Got to have some risk management plan. But let's say we're trying to make about 10% of this. It'd be 80 or 85 bucks. So if I sell it at 150 credit, I buy it back at 70-cent debit. That'd be close to 10%, right? And let's say I don't want to lose more than 15%. And again, it's 15% of your margin, not your credit. It'd be like 120 bucks. So if this were to get to, the spread were to get up to 270, I would get out, right? That'd be like, let's see, 120, 150, 270 or higher. Now, this is a basic, quick risk management plan with no adjustments or anything. But again, the reason I even bring this up so quickly is just, you don't just whip stuff on, right?
Right.
And go from there. But, that's something, that's an easier thing to grasp. How many do credit spreads? How many of you guys do, and ladies do, credit spreads? I think they're fine if you have a plan, right? You know what you're.
Yeah, that's really the key.
Yeah. And again, remember, there's no cake and eat it too, folks. How many think to bring in $1.50 credit of risk of $8.50 is a good risk reward? How many think to bring in $150 to risk $8.50 is a good risk reward? Is that good or bad? What do you guys think? To bring in $150 to lose $8.50, I would call that bad. Right? That's like, what is that, Mark? Like 7-to-1 risk reward.
Yeah, something. Well, yeah, probably closer to 6, I guess. But yeah.
Yeah, but a good or bad risk reward doesn't make it a good or bad trade. How you manage it is the key. If you're going to get a good risk reward on a credit spread, then your probabilities stink. If you're going to get a good probabilities, that's not good English. If you're going to get good probabilities like we have here, the risk reward stinks, right? And in this particular strategy, I picked the short strike by going to maybe a 20 delta. You say, what does that mean? It just means there's a 20% probability that we will, in the next 25 days, close under the short strike. So probabilities are in our favor. So that's one trade we will be looking at. And then I'm going to, you know what? I may let Mark, you got your machine there?
I do.
I may let you take one thing we've been looking at. And for a lot of you, if you're, how many are new? How many have never done a calendar trade before? Maybe newer and maybe haven't done a calendar trade. Anybody? You're all calendar trade experts? I don't think so. Chuck's the only one who's taking the energy to take his fingers off his computer and type. Okay. Juan is another one that got the energy after lunch to type in. All right. So Mark will go over, and I say GLD because the calendars in GLD are going to be much cheaper than like a SPX, and you could do SPY, but this is something we've been doing lately. Mark, why don't you share your desktop? Talk a little bit about, I think it'll be fascinating for people as you talk about gold, GLD, how the volatilities work, and the calendars just a little bit, and maybe show an example.
Okay, so gold, it has a lower volatility than the VIX. In fact, right now, gold is in a pretty good range. There's kind of a support underneath it because of all the inflation, sort of a imaginary put, so to speak, that protects it. You can see we've dipped down around the 177.5 area, but most of the time here in the last few weeks, we've been in a nice range, and calendars have been working really well. A couple things about GLD. One, it's a pretty small vehicle, isn't it? It's only $181. And if you did a calendar, let's just say you did something for a week from this Friday, and they're going to be 7 days wide. You're going to sell one expiration and then buy the next expiration, which will be 7 days away, and it'll look like this. Okay, where we trade one. Okay, let's move this up to 182. So the way a calendar works is this long on the 29th, it's decaying slower than this short on the 22nd. So one of the things that makes you profitable is you're trying to take advantage of the fact that short's decaying at a much faster rate than the long. That 7 days is a lot in as far as time decay goes. And you're looking to get that spread between how slow the long is decaying and how fast the short is decaying. And it's a positive theta trade every day. Well, today you'd make $1.86. Now remember, folks, I'm talking about one contract in a very small vehicle. Of course, whatever your skill level and risk tolerance level is, you can scale this up. But this is a vehicle that's been doing well with calendars in a market like the SPX, where a lot of times we struggle to, even want to put them on if the VIX is too high. the volatility. But in calendars, they've been doing better. Now, one thing to remember about GLD, it is the ETF for gold. It trends around with gold futures. It's easier to trade than the gold future, and it's very liquid. But when gold or GLD, when the price goes up, that's when volatility goes up. It's the opposite of the SPX or the broader market, because in a broader market, most of the market participants, 80% or so, are all long, and they don't mind if market's going up. They're happy, and that causes lower volatility. It's when the market goes down, they don't like that, and you have higher volatility in things like the SPX. But in GLD, this is a commodity, a fear-based trade. People think, oh, that thing's getting away from me, I've got to grab it now. The same thing with oil or gas or all those things. It can really go up hard to the upside, and it can have a lot of volatility with that because people are clamoring to protect themselves, to buy, maybe buy calls, whatever it takes. So you can be the beneficiary of increased Vega in this trade. It is Vega long, and generally gold's been doing pretty well. I mean, I know it was down a little bit ago. It was up a lot earlier today, but it's pretty firm. So that should keep the volatility, at least in the long, pretty firm, and keep you to be able to just use time decay. And with something like this, one other thing, let's suppose you just did it 5 times. So 5 times would be about $300, right? 5 times 62. But you got to remember your fees. And I don't know what your fees are like wherever you're trading. Mine are 65 cents a contract. So this trade would be 10 contracts total. That would cost me $13 to put this on and $13 to take it off. So it'd be $26 in fees. So with a smaller vehicle like this, you wouldn't want to go for just 10%. You'd want to go for 20 or 30 to cover those fees. And you are generally risking smaller amounts. I mean, this is not a big trade. You can make it as small, as you want. But that's why I think it's an interesting trade, particularly in these volatile times when you can still get a calendar on in it. It does the opposite of what the SPX does generally. If the SPX is up, gold's usually down, vice versa. And the same thing with the volatilities. And I think, and it's something that's nice and small for new traders. They can kind of get a feel of how you're trading calendars with GLD. All right. That would be true if you had 10 contracts at 60. Oh yeah. Well, I was talking about in and out. So it's $1.30 for, I think you're right. I did that backwards because I've been doing this with 10 all day. You're correct. Yes. I did this, my math with 10. 10 would be $13. 5 would be 65. You're correct. I've been giving examples all day with 10 contracts. So you're right, Harry. Round trip, $13, even cheaper. But it all depends on what your fees are, and make sure you're covering those in and out and getting, a larger percentage profit than normal with something like this. Okay. Dan, did you want me to talk further on it? Where Dan is? Dan. Okay. Has anybody ever done a calendar in GLD, or is this new to folks? Yeah, it is. It's an interesting vehicle. It's really interesting to do calendars in a vehicle that, normally I've done them in SPX, and when volatility goes down, that's usually when the price is up. But this one's the opposite. The price starts going up, your calendar can get bigger and wider because the volatility can increase in your favor. But I am very bullish gold long-term in GLD. Of course, because inflation is probably it doesn't look like it's going to be broke down anytime soon. So I think we can. I think gold should probably enjoy a good year. I think we'll head on up. I think in GLD, I think we'll get to 200. Sometime maybe even by summer, because inflation is very, very tough to combat, and in times of high inflation, people like gold.
All right. Well, thanks, Mark.
All right.
That's good. Maybe let me take that. I just want to do 2 more quick things. You can comment with me here. Let me take over the thing. Maybe as I do.
And Juan, no, it's like I said earlier, it's too small. You would probably want to go for 20 or 30% profit. Yeah.
All right. All right. I want to go over two more trade ideas before I do. All right, folks. I just want to make a couple quick things. Obviously, this is the front page of Sheridan Mentoring. What's interesting, if you ever go to Sheridan Mentoring page, unlike others, when you see these, interesting with us, when you come to that little box will pop up. I'm always tempted, Mark, if I type up Sheridan Mentoring and that box pops up with Johnny, who's my nephew, to, jerk him around a little bit and put little, messages on there and on him. But, he'd get tired of that quickly. But that pops up and you see a face. And how many of you would be surprised that when a box pops up, that person is actually at the other end and would pick it up, would ask you any question? That would be unusual, wouldn't it? Because I know I've done this with like companies, and there'll be like a bot, or it'll show, some person. But with us, we only have Johnny. That's it, folks. It's Johnny. He has that going most of the day. So if you ever have any question, this is for us. This is a good way if they come in. Johnny, it'll be Johnny. It won't be me, right? It won't be Mark. It'll be Johnny. So just let Johnny's all we need. So if you ever, just to let you know that. Now, this is about the webinar today, but I want to just alert you to something we've done in the last 6 weeks. A lot of these on-demand courses, deep dives, we call them, into the different strategies. Here's one that Mark did, hot off the press, calendars, and Jay Bailey did one on volatility levels. I see a couple people asking about volatilities. This is as good a video as I've seen on how we use volatility in our trading, which is huge. And Mark's done one. Calendars have been one of our top strategies over the years, and he just spells it out here really good. And I think that'll be a help to you. But I just want to click on something. If you click on this where it says on Sheridan Mentoring online classes here, if you click on that, after you say hello to Johnny, right, and give him a joke, he likes jokes. But if you look here along the right-hand side, I just want to let you, literally, these have all been done in the last 3 weeks or so. On the right side, new on-demand deep dive courses. Here's the SPX calendars Mark did, Volatility by Jay. I did one on iron condors. In there, I included a couple bonus videos on 0-day iron condors, 1-day iron condors, which have been very popular. SPX call ratio back spread. Mark did a good trade in a volatile environment. And then I included a bonus video on how we did them when we were in the pits, how market makers did them and how they could be applicable. The wheel strategy with Jay did, double diagonals, and then, on the left, some portfolio classes. So make yourself familiar with what goes on there. And of course, for the practical, really practical, the 3K class every month is where we do the live trading and stuff. So just wanted to let you know, and we'll go from there. All right, let's get back to Sanjay says, any thoughts on using ratio put spreads for protection on high vol stocks you may have? If you do them in stocks, because they don't have the volatility skew, Sanjay, of the SPX, sometimes that can look good, like doing a 2-to-1 ratio against a long stock. I've seen that done before. Is a possibility. All right, so if we bring up SPX, can you see my screen, Mark?
I can.
So one thing I talk about, again, is the volatility pop today. Again, trades I'd be looking at maybe today to do kind of an equidistant centered iron condor with us currently at the SPX up at 44.27. It's starting to go down a bit. Relatively, you want to center it. Here you have a short put at 4,200. short call at 46.60, relatively centered. And right now, and again, this is 25 days out in May 6th. This is about 25 days out, and it's going for like a 260 credit. So your margin or risk on this would be $740. But that's another thing that I think looks interesting right now. And on a day like today, I might choose my strikes by selling a 10 delta call and a 20 delta put. PCAT says, does the wheel strategy actually work? Again, in the hands of somebody who understands how to use it, like Jay Bailey, I mean, it does. Yeah, the wheel strategy, which is, I think Mark, it encompasses this, the whole formality of somebody sells a put, right? If I'm correct on this, they sell a put. Okay, you could bring in your monthly income or weekly income on the short put. If you get assigned on the put and it becomes stock, you could sell calls against it. And it's this whole process of going from short put to stock. And again, the key to any of this stuff is having a risk management plan. How do you do it? I think that's the one thing I've seen different than how Jay does the wheel strategy versus anything I've seen is he gives a plan. He talks about risk management so you actually could do something with it. Chet says, for the wheel, wouldn't it be a better selling a bull put spread instead of cash secured puts? I mean, I would prefer to do that, Chet. I mean, I think it's an inefficient use of capital to just sell a put because you eat up a lot of capital. But let's face it, Chet, are there more people in the world who sell puts than do put credit spreads? I would think so. I think people are just used to, they understand that concept. So I think the wheel was our way of reaching out to people who it was kind of a bridge. I look at the wheel strategy as a bridge strategy, right? You're reaching out to people who are more familiar with stock than options and saying, hey, here's some thoughts on doing this. And you're basically trying to gently massage them to move over to options, right? The wheel strategy is in the course that Jay did, the on-demand course that Jay did on the wheel. That's on our website. And again, all our on-demand videos are deep dives into it, very intensive, and they're $247. All right, so the iron condor. And then the last thing, Mark, we're going to end this on the dark side. You ready?
All right.
We're going to end this on it. So how many of you would say, hey, Dan, this is a shortened week, Thursday's the last day. How many of you think right now SPX is 44.30? How many people think that SPX will be up by Thursday? Now, here's the good thing about voting. You can only vote one of two, right? So here, folks, this is a free one, right? Yes or no? Now, folks, you know what it means when you get many, many more no's than yes? You know what that means? What do you think it means when you get many more no's than yeses? It means we're going up.
I can see that.
I'm joking. Yeah, go contrarian. Yeah, but let's pretend here and you could go either way, right? And this is totally spec. This is just something different than we normally do. We'll do it in a smaller size minority. But if I'm going to take ever a directional play, and I think Mark is pretty similar, one of the strategies that Mark and I use for a directional play, Mark, wouldn't you say, is a directional butterfly. We'll call it a time bomb.
Yeah, a time bomb. Been using that a long time.
Yeah. And the reason we do is because how many of you do a directional play? Maybe you buy a call or a put, but do those strategies have the potential of ripping your face off? That's I didn't mean to use such a graphic image, but if you're wrong, yeah, I call this, the reason I like it, this is the wimpy way to go long or short, right? If you're wrong on a directional butterfly, generally they don't rip your eyeballs out, right? It's a little more gentle in most cases, right? So,
Yep.
but I put one for this Friday, right? So this is more of a home run. If I wanted a little more conservative, I'd go out a couple weeks. But let's just say, here's an example in SPX. Let me open this up a bit. And let me set it up, and then we can kind of talk about it. And it's a little shot, right? And anytime you talk about a speculative move, you're only using capital that you're prepared to lose, right, Mark?
That's right. That's what's good about this. You could use a very small amount.
Yes. This isn't, and you think about it, SPX is a $4,400 vehicle. And so we're going to play a $4,400 vehicle for a couple $100. That's pretty good, right? And so this is not mortgage money. This is not food money. A little extra. So here's the idea. And for me, this has always helped as far as timing, because, you can say, well, where do you think it'll move? Because we're only talking 3 days. So the only way I measure it up, I'll look at, like, here we've got, and Mark, you maybe share how you do it, but if we look at April 14, here's this Thursday, right? I will look at maybe a 30 delta, and I'll explain that to you in a second. Let's see if it gives me that. Give me a second. So somewhere around here. So it's saying a 30 delta means there's only a 30% probability we're going to finish over 44.80 by the end of the day Thursday. But how many ever heard this concept about a 30 delta also would mean probability of touching, right? If it's a 30 delta, there's a 60% probability, right, that will touch the 44.80 strike in the next 4 days. So if this is where we're at today, I'm placing 2 short calls at 44.80. So we're 50. So basically you're saying if SPX goes up 50 points, right? But again, you don't even need that much. And then we're buying his hedges, 44.60 and 4,500. And this costs $200, right? Now, and what we're saying is if SPX is between basically 44.60 and 4,500, even by Wednesday, right? Tomorrow or Wednesday, and the more you get in this area, you got a good chance to, make 50% or more on your money on this thing. I mean, that's what I'm going for with this type of a trade. And if it goes against you, if I'm looking to make 30, 40%, I don't want to lose 30 or 40% on the trade. Now, this particular one expires on Friday. So it's not as, what would the word be, Mark? Warm and fuzzy as if you did this 3 weeks out. But
no, I mean, it's very short time to work.
But if it gets in this area by Thursday, you're not hitting a single, you're hitting a homer.
You absolutely.
Right? And it's a cheap shot. Yeah, I didn't Robert, I didn't get into, we talk about unbalanced butterflies a lot, unbalanced time bomb flies. You could, but these are cheaper dollar-wise if you do it balanced versus unbalanced. And you're really not swinging the deltas. We're under a delta long, but I think these are little plays. And again, let's say this costs $200. You say, what would be the size? Well, if I'm willing to risk $400 and I'm willing to lose $400, I do 2 contracts, right? So I take the approach, I could lose the whole thing, which you should, right? For any spec trade.
Mm-hmm.
And, but again, those are more forgiving because you think of the journey of a directional butterfly, right? You know, we're at 44.32 right now in SPX. So we're basically betting it goes up 50 points. But we'll look at if we take you through the progression of this. You know, if I buy a call, a 44.60 call, right, in SPX, does everybody agree it costs a boatload of money, right? Well, everybody agree that if you buy a April 14th 44.60 without looking, it's going to be a boatload of money. And can somebody say yes? Yes. So going against that, you say, well, one way I could still be bullish but cut my risk, do a call vertical debit spread. So against my long call, I can still be bullish. I sell a 44.80. All right. So this vertical is cheaper, much cheaper than if I buy a call. I still could participate in the upside, but it's less risk. Now, yeah, on the other side of the coin, yeah, if the market just screams up, you wish you had the long call. But again, to me, this is a wimpy way to get long, right? But you can play a lot more. Now, if you even want it cheaper than this, right? This is called a call vertical debit spread. If I go and sell a call vertical credit spread using the same short strike as the call vertical debit spread, and then go out 4,500. So step 1, do I buy a call? That takes a lot of money. Step 2, I sell a call against my long call. I have a call vertical debit spread. Well, to make it even cheaper long shot to the upside, if I sell a call vertical spread against a call vertical, I'll do it for a small debit, right? Whereas I'm guessing if you just went and bought a call, that's going to cost you $30 or something. I don't know what they're trading at. But so anyways, this is a cheap way to get long here. Anyways, we threw a lot of things at you today. Folks, good to talk with you. We'll come back another time. But Mark, any final words of wisdom?
No, other than, with this course, you can learn risk management. We really pound on that one, and that's key because trading is more than just winning. It's protecting yourself in tougher times. And this course really helps you with that.
All right, folks, have a nice day. We will see you later and take care. Thank you.